From bartering to commodity, the early days of exchange. In the beginning, there was no money. People traded goods and services directly. This is called bartering. Imagine a farmer trading a bushel of wheat for a pair of shoes from a cobbler. This system had limitations. It was difficult to find someone who had what you needed and wanted what you had. Gradually, people started using commodities as a medium of exchange. Commodities are goods that have intrinsic value, like salt, cattle, or grain. These were widely accepted and could be traded for other things. However, commodities were not always easy to transport or store. Precious metals like gold and silver emerged as a more convenient form of commodity money. They were durable, divisible, and held their value. People started using gold and silver coins as a standardized medium of exchange. This made trading much easier and more efficient. The goldsmith's revolution. Paper money enters the stage. In the 17th century, goldsmiths in London started a revolution in the way money worked. People deposited their gold with goldsmiths for safekeeping. The goldsmiths issued receipts for the gold deposits. These receipts became a form of paper money. People began using the receipts to make payments instead of carrying around heavy gold. This marked the early stages of paper money. Goldsmiths realized they had more gold than they needed for withdrawals. They started lending out a portion of the deposited gold. This was the beginning of fractional reserve banking. Goldsmiths created money by issuing more receipts than the gold they held in their vaults. Money in the digital age. How banks create money today. Today, money exists mostly in digital form. We use debit cards, credit cards, and online banking for transactions. Physical cash is only a small fraction of the total money supply. Banks play a crucial role in creating money today. When banks give out loans, they don't simply lend out money they have on hand. They create new money electronically. This increases the money supply. This new money is created in the borrower's account, ready to be spent. This process of money creation through lending drives economic activity. When more money is available, people and businesses tend to spend and invest more. This can lead to economic growth. However, it is important to manage the money supply carefully. The government's roll bonds, inflation, and the big picture. Governments also play a significant role in the economy through their influence on money. They issue bonds to raise capital for government spending. When you buy a government bond, you are essentially lending money to the government. Inflation is a key concept related to money. When the money supply grows faster than the supply of goods and services, prices tend to rise. This is inflation. It erodes the purchasing power of money. Central banks try to manage inflation by controlling interest rates and the money supply. They aim for a balance that supports economic growth without excessive inflation. Understanding how money is created and circulated is crucial for making informed financial decisions.